Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the stock market for 2019 and beyond. Rather, it's a view of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I'll point out the information I think is most relevant. The opinions expressed are mine, and not necessarily those of Raymond James, and J.P. Morgan is not affiliated with Raymond James. This quarter, four main themes I want to stress. We'll start with an economic update, talk about interest rates and expectations, the equity market assumptions, and as always, what investors should be doing. I don't have to tell you that last year was difficult in the equity markets. January was strong, but then we got into periods of volatility. The roller coaster ended on a negative note, with the fourth quarter and December in particular erasing the returns for the year. There was no Santa Claus rally this year. However, as bad as the last quarter felt, the year saw only about a 4.4% loss in the S&P 500. The bad news for American investors looking for growth overseas is that a strengthening dollar made overseas losses even deeper. Overall, it was a tough year. Like it or not, the U.S. leads the world economically. When we fall into recession, the world tends to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. Year-over-year GDP growth was over 3% in the third quarter. You can see on the left-hand chart that there is an unmistakable rising trend in GDP growth in recent quarters. On the right, we're looking at the components of GDP. Consumption always makes up the largest chunk in a market-driven economy. It's important as investors to know how consumers are doing financially. GDP growth is returning to historical averages. These four sectors tend to be indicators of future economic growth. On the left side, we see factors for individuals, and on the right are business indicators. Generally speaking, consumers are still trying to get back to normal growth rates, and business spending is strong. The bottom line is none of these factors is currently pointing toward recession. One of our long-term risks is government debt. Currently, paying interest is about 9% of the federal budget. As more debt is accumulated and interest rates rise, the cost to carry the debt will increase. Although it is manageable now, sooner or later the government must show some financial responsibility. The dangers are considered to be far in the future still, but it is a long-term danger. Notice in the bottom right that the federal debts are expected to increase the rate of growth, and that's not a good trend. See the bottom left chart for CBO expectations for the economy. For this year, the CBO expects GDP to grow by 3%. Going forward, they see growth rates slowing back to sub-2% levels. This is one of the main reasons for the volatility of the fourth quarter, anticipated slowing of GDP growth. Just a quick touch on oil this quarter. Inventories are stable and expected to grow this year. That's why you see the price of oil getting back to the $50 per barrel level. Inflation remains tame at around 2.2% for core inflation rates. Manufacturing momentum is slowed globally. We see more areas of yellow and orange this quarter. Economic activity is cooling a little bit, and trade discussions are a part of it. Among developed markets, Italy is particularly troublesome. It hasn't gotten much press, but the debts they have accumulated are enough to threaten the euro itself. The EU doesn't have a solution to this problem yet. The unemployment rate continues to fall. Although wages had been fairly tame until last year saw wage growth accelerate. This is evidence of a constricting job market and a signal of a potential for higher inflation going forward. The labor force participation rate has stabilized near 63%. This is an area with the potential to increase the supply of labor as labor markets constrict. Because wages were stagnant for so long, profit margins are a much greater share of nominal GDP than normal. As you can see, this isn't the normal situation. If this persists, laborers are likely to see a remedy at the ballot box. This is a recipe for political change. Note also that recessions tend to coincide with sharp rises in wages relative to GDP. That is not currently a problem. As a signal, this indicator is not signaling recession. Let's talk about interest rates. When this chart was made, the Fed was projecting 2 more interest rate hikes to get north of 3% for the Fed funds rate. Since then, the Fed has noted the impact of their December increase on the financial markets and has backed off. They are now not expected to get higher than 3%, and may have only one rate hike left, if that. As shown earlier, the economy is showing signs of slowing and inflation is tame. There is room for caution by the Fed. 10-year Treasury yields were on the rise into the third quarter. However, the change in investor attitudes toward equity risk increased demand for bonds and brought yields back down. Investors have a tendency to look back to the previous peak of rates and assume that is the eventual future, but not necessarily. Expectations are for yields to return to long-term averages, not necessarily back to the high levels that we saw in the early 80s and late 70s, or at least for the foreseeable future. Generally speaking, rising interest rates tend to reduce the value of bonds. In a rising rate environment, that tends to reduce their effectiveness as an investment, as there is very little value given to the risk of holding them. In this environment, bonds may be useful as a diversifier of risk in a portfolio to provide value in volatile markets. The yield curve is flattening. The main reason is the Fed is operating at both ends of the yield curve. They are raising short-term rates and holding long-term rates low. Mathematically speaking, long-term rates above 4.2% are detrimental to government finances. This is one reason the Fed is going to be more cautious with rate hikes to the Fed funds rate. An inverted yield curve tends to be a reliable predictor of recessions. Normally, the yield curve inverts due to market forces and is a signal of a weakening economy. If the Fed allows the yield curve to invert, they could set up a self-fulfilling recession where investors shun risk assets and slow economic activity. There have been yield curve inversions which did not immediately precede recessions, so we need to be aware of the relationship this situation suggests, but not put too much faith in its predictive power. Look in the chart at the upper right of this slide. Some investors assume that having bonds in a portfolio is a way to diversify risk. Although generally true, it does matter what quality of bonds are held. High-yield bonds tend to be strongly correlated to equities. Investment-grade bonds tend to be less correlated during times of equity volatility. In other words, higher quality bonds are most valuable as a diversifier when markets are most volatile. Let's talk about equities. Between March 9th of 2009 and the end of September 2018, the S&P 500 increased by 271% excluding dividends. That's a huge increase, but it's less than it was last quarter. Those with a short-term view of history could be forgiven for seeing a market peak at these levels. Consider, though, that we have been through what's known as a secular bear market. There are really two phases when evaluating PE ratios. The secular bear is where PE ratios are contracting, and the secular bull is where PE ratios are expanding. The only way you'd know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 14.4, and that's down from 16.8 last quarter. The yield on the S&P 500 is now a little more competitive with 10-year treasuries. The main reason to invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, earnings have picked up and have resumed their track to record levels. Note that future earnings are expected to take a pause in their growth. This is another reason for the recent volatility. When we last met, this dip wasn't anticipated. It is evidence of a slowing economy. When we last met, forward-looking PE ratios were above the long-term averages. The fourth quarter has brought these ratios down significantly below the long-term average. There is room for growth without reaching extreme valuations. This chart shows secular bulls and bears. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time will answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. As mentioned earlier, strength in the U.S. economy helps to bolster overseas economies. Overseas valuations are more attractive than domestic markets. Would you want to go back in time relative to the S&P 500 and invest at lower valuations? That's kind of what's represented overseas. No investment is without risk, and this isn't a sure thing by any means. But the valuations are more attractive here than in domestic markets. If global growth improves, this may be a way to increase portfolio returns beyond domestic expectations. So what should investors do? Well, what's going to drive the markets forward? Generally speaking, inflation, economic growth, and global conditions tend to be strong fundamental drivers. It's important to consider these factors to get a handle on expected returns. Financial drivers like interest rate movements, the premium investors' demand for risk assets, and valuations are kind of wild cards for market movements beyond the fundamentals. Historically speaking, from 1950 to 2015, the labor force grew by 1.5% per year, and productivity grew by 1.7% per year. GDP grew by an average rate of 3.2% during this time frame. Looking forward, economists expect the labor force to grow by 0.5% per year and productivity to grow by 1.6% per year. This gives the expectation for 2.1% real GDP growth. An increasing labor force participation rate, or immigration, could cause the labor force to grow at a faster rate. Putting the pieces together from this presentation, we can see that GDP growth is expected to be 2.1% per year going forward, dividends are expected to grow at 2.7% per year, and inflation is expected to remain around 2.2%. This adds to an assumed return for equities of 6.9%. That is a baseline assumption. Any additional growth from that baseline will be driven by changes to the P/E ratio, increasing asset values relative to earnings. That factor is difficult to forecast. There is a great deal of cash relative to GDP sitting idle in the economy. The chart on the right shows that over $16 trillion remains on the sidelines in various cash equivalent accounts, and that's higher than last quarter. That is more than both consumer spending and mortgage debts. These cash assets are non-productive assets for growth and a fuel for further investment returns when they're finally put to work. The chart on the left shows that cash investors, and those in CDs, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make money. Investors in CDs are accepting that they're not coming close to keeping pace with inflation. The main market alternative to stock dividends is to take on interest rate risk in the bond markets. As shown earlier, bonds aren't a good long-term proposition in my opinion, if we realize rising interest rates. It takes courage to invest. Even though the market finished positively 75% of the years in the last 38, the average year saw an intra-year decline of almost 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor long-term growth. The dip we saw last year of 20% ended at a loss of only 6%. Those who were hurt worst were those who panicked. We would all love to be able to invest without risk. If I offered someone an investment which would have an average return around 7% a year, most people would jump at it. That's the red line. What that line represents, though, is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis, or the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in the portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of around 50% in the S&P 500 just to return to the 7% average line. Last year is just a small blip at the end. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have seen even better results. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can make growth a smoother ride for investors. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may return to the normal situation where managed money beats unmanaged money 2/3 of the time. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against loss. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as the returns reflect an average between them. But that isn't what we see. We find that the average investor has a much lower average return. In fact, at 2.6% per year, the average investor has barely kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I am always happy to review and answer questions. These disclosure charts can be a bit of an eye chart, especially in a video. My presentation is available on my website, and you can get a closer look at these as you desire. Thank you for taking time to review this presentation. If you have questions, all of my contact information is on this final slide. The Capital Markets Review is a quarterly presentation to keep investors informed on the financial markets. Please join me again next quarter.